In 1941, Austrian writer Stefan Zweig published a book called Brazil, Land of the Future. 85 years later, Brazilians have a bitter joke. Brazil is the country of the future, and always will be. And here's what makes it maddening. Brazil isn't poor. It isn't unstable. It isn't even badly managed by emerging market standards. Something else is going on. Brazil holds the eighth largest economy on Earth, $2.3 trillion in GDP, more arable land than the entire European Union, pre-salt oil reserves rivaling the Persian Gulf, the world's largest tropical rainforest storing 150 billion metric tons of carbon. And yet, per capita income has stagnated at roughly $11,000 since 1980, the same level as South Korea 4 decades ago. Today, Korea earns 3 times more. So what happened? How did a country with every natural advantage end up running in place while others sprinted ahead? The numbers right now are flashing red. The real lost 27% against the dollar in 2024 alone, hitting historic lows. The Selic rate stands at 15%, among the highest in the world. Government interest payments now consume over 7% of GDP, more than Brazil spends on education, more than it spends on infrastructure, more than it spends on health. Brazil's debt-to-GDP ratio is projected to hit 84% by 2026. And here's the paradox that keeps economists up at night. Despite these punishing rates, credit is still growing. Unemployment hit a record low 5.2% in November 2025. GDP growth has surprised to the upside 3 years running. And yet, markets remain skittish. Something fundamental keeps pulling Brazil backward. And what we're about to discover is that Brazil's greatest assets might be its greatest curse. Now, here's why you should care even if you've never set foot in South America. If you own any emerging market ETFs, Brazil is likely 5 to 10% of your portfolio. China takes 27 to 28% of all Brazilian exports. If China's property crisis deepens, your portfolio feels it. To understand why Brazil keeps falling into the same trap, we need to go back to where the trap was first set. The 1970s were supposed to be Brazil's moment. They called it the Brazilian miracle. GDP grew 10% or more every year under military dictatorship. The government borrowed heavily, built infrastructure, modernized industry. Brazil seemed destined for greatness. Then came August 1982. Mexico defaulted, and that single event triggered the Latin American debt crisis. Brazil's foreign debt exploded from $29 billion in 1970 to $327 billion, suddenly unpayable. What followed was the lost decade, and I mean lost. Hyperinflation reached 2,477% annually by 1993. Brazil cycled through 6 different currencies in 10 years. 6. The Cruzeiro, the Cruzado, the Cruzado Novo, the Cruzeiro again, the Cruzeiro Real, and finally, the Real. People rushed to spend their paychecks before the money became worthless. Supermarkets would change prices 3 times a day. This was economic chaos at a scale most of us can't imagine. Then came July 1, 1994. Finance Minister Fernando Henrique Cardoso introduced something called the Plano Real, the Real Plan, and it was genius. They created a virtual currency first, the URV, that people could trust. Then they converted everything to the new real. Monthly inflation fell from 48% to 1.9% within 8 weeks. Poverty dropped from 30% to 20% within a single year. Brazil finally seemed ready to take off. But the Real plan contained a fatal flaw, one that would take 20 years to destroy Brazilian industry. And almost no one saw it coming. The very mechanism that saved Brazil, anchoring the real against the dollar to fight inflation, would become the chain that strangled its manufacturing sector. We'll come back to exactly how that worked, but first, you need to meet the characters who built and broke modern Brazil. Fernando Henrique Cardoso, FHC, the architect of stability. President from 1995 to 2002. He implemented privatization and fiscal reforms, but the structural transformation of taxes, education, and infrastructure, that never followed. Lula da Silva, union leader turned president. He ran Brazil from 2003 to 2010, lifted millions from poverty with Bolsa Familia. Then he was imprisoned in 2018, conviction annulled in 2021, and in 2022, he was elected president again, the most consequential and controversial figure in modern Brazil. And trust me, his story gets much stranger. Petrobras, the state oil giant, symbol of both national pride and systemic corruption, at the heart of the largest scandal in Latin American history. We'll get to that. And the Bancada Ruralista, the agribusiness lobby, the most powerful political bloc in Brazil. They control Amazon policy. They dominate Congress with more than 20 parties. The Plano Real worked. Brazil stabilized. So what went wrong? Here's what most people miss. The very thing that saved Brazil became its curse. Economists call it Dutch disease. And if you haven't heard that term, here's what it means. When natural resource wealth paradoxically destroys other industries by making the currency too strong for manufacturing to compete. Between 2003 and 2011, during the commodity supercycle, the real appreciated from very undervalued to very overvalued, a 2 standard deviation swing. Foreign reserves quintupled from $38 billion to $350 billion. Sounds great, right? But the strong currency made Brazilian factories uncompetitive. Manufacturing collapsed from 34% of GDP at its 1984 peak to roughly 10 to 12% by 2024. Brazil didn't just catch Dutch disease, it caught the most severe case in modern history. But here's where Brazil's curse gets truly diabolical, because the money flooding in didn't just kill factories, it rewired the entire economy to depend on a single customer. The numbers tell a brutal story. Commodity exports, soybeans, iron ore, crude oil, rose from 34% of total exports in 1985 to approximately 70% today. In 2024, crude oil overtook soybeans as Brazil's top export for the first time in recorded trade history. $44.8 billion worth. Brazil exported its factories and doubled down on dirt. Look at the current export structure. Soybeans and products, 17%. Crude oil, 13%. Iron ore, 9%. Manufacturing exports, 54%. But that's mostly processed commodities anyway. And China alone takes 27% of everything Brazil sells. The mechanism is textbook Dutch disease. During the boom, the strong currency made Brazilian manufactured goods uncompetitive globally. Import penetration doubled from 10 to 20% between 2003 and 2011, hollowing out domestic industry. Textiles lost 175,000 jobs. Capital goods manufacturing collapsed. Electronics stagnated at roughly 1% of GDP, while China's manufacturing value added grew to 31 times Brazil's level. Let that sink in. 31 times. Unlike oil-rich Norway, which saved its commodity wealth in a sovereign fund, Brazil spent the windfall on consumption and corruption. Between 2003 and 2014, minimum wages rose 68%, while productivity per worker increased only 21%. Here's how one analyst put it. Brazil has become a poster child for the middle-income trap. The combination of this with Dutch disease has caused crippling premature deindustrialization. Think of it like this. Imagine your neighborhood had a gold mine. Great, right? But the gold rush makes your local currency so valuable that the bakery, the mechanic, the clothing store, they all go bankrupt. Imports become cheaper than anything they can produce. You're richer on paper, but your entire local economy has been hollowed out. That's Brazil at a national scale. Now, remember how I said Brazil rewired its economy to depend on a single customer? Here's how fast that happened. In 2000, China absorbed less than 2% of Brazilian exports. By 2024, that figure reached 28%. Nearly $94.4 billion in shipments. Three products account for over 75% of everything Brazil sells to China: soybeans, iron ore, and crude oil. For soybeans specifically, China takes 73 to 76% of Brazil's entire crop. Brazil supplies 70% of China's soybean imports. For iron ore, 71.2% of production flows to Chinese steel mills. This concentration creates profound vulnerability. When China's property sector crashed in 2023 and 2024, the effects reverberated through Brazilian commodity markets immediately. January 2025 delivered a shock. Brazilian exports to China slumped 30% year over year. Soybean shipments collapsed 68%. Brazil recorded an unprecedented trade deficit with its largest partner. The trade relationship exhibits asymmetric power dynamics. Brazil ships raw materials. China returns manufactured goods worth $72 billion in 2024, up 23% year over year, including 91% of all new energy vehicles sold in Brazil. And here's the kicker. Cofco, China's state-owned grain trader, is building the largest export terminal outside China at the port of Santos. Capacity? 14 million tons annually. Analysts note Cofco can increasingly dictate freight terms and payment schedules. Now, Brazil runs a substantial trade surplus with China, about $48 to $49 billion in 2023. The relationship isn't purely exploitative, but the surplus masks how Brazil's industrial base continues eroding, while Chinese state enterprises gain leverage over critical logistics infrastructure. Hey, quick question for the comments. If you were managing Brazil's economy, would you double down on the China relationship for short-term cash, or try to diversify, even if it means slower growth? Let me know below. This brings us to the third piece of the puzzle, the currency trap. Currency volatility has defined Brazilian economic life since the Real plan. The Real launched at 1-to-1 parity with the dollar in 1994. Then it crashed, and crashed again, and again. October 2002, 3.95 to the dollar. Lula's first election, fears of radical populism. January 2015, 4.05, the impeachment crisis. March 2020, 5.90, COVID panic. January 2025, 6.31, all-time low. Brazil maintains some of the world's highest real interest rates, currently around 10% above inflation. Why? 7 sovereign defaults creating persistent risk premiums, low domestic savings, directed credit subsidies where 40% of lending happens at below market rates, forcing policy rates higher, traumatic inflation memory, and high exchange rate pass-through. The 2024 depreciation, that 27% crash, stemmed from domestic fiscal concerns, about one-third, and external factors including U.S. monetary policy, about two-thirds. The November 2024 fiscal package disappointed markets by delivering only 70 billion reais, about $11 billion in spending cuts, while simultaneously announcing income tax exemption increases. Here's the vicious cycle. The 11+ percentage point spread between Brazilian and U.S. rates creates a carry trade magnet. Investors borrow cheap dollars, buy high-yield Brazilian bonds. Every time the Fed raises rates, capital flees Brazil, the real crashes, inflation spikes, rates go higher. Repeat. By the way, this makes Brazil one of the most popular destinations for currency speculators in the world. And if you own any emerging market bond funds, you might already be invested in this trade without knowing it. But the currency and commodities are just symptoms. The real disease runs much deeper. Remember when I mentioned Lula's story gets stranger? Here's where it gets wild. The Petrobras scandal didn't just expose corruption. It exposed how the entire Brazilian system actually works. Operation Lava Jato, car wash. It started at a gas station in Brasilia and ended up jailing presidents, CEOs, and revealing an estimated $2.1 to $2.6 billion in direct bribes. Total corruption-related losses? 42 billion reais. That's $8 to $9 billion. But here's the twist that no one talks about. The economic damage from the investigation may have exceeded the corruption itself. And the man prosecutors of opportunity and state by the man property into the world. The man is even fifth of the man property and state when the Brazilian his differently work may have exceeded the corruption. The man with inclusive the monetary is the true on the development rates or broad the rates. But the man property and state that rates on the agree is it. The economic political investigation has memorates simply prevention, but the world is a very billion. But even though later in billion from the economic damage from the events to the corruption is from me by the even justice at its state. The real is justice from them, be only given a real problems of informate. The man breathed it leaved between them, but they are against from the world. But the man work become the four from the Rome. But the man believed is every single president that brings the Brazilian at 1% and even me, because they didn't. The man method very absolute may have a necessary of their billion. They build the informate without. The currency Brazil, but here's just twistedy because they won the 20 presidential election and now governs Brazil. Remember Stefan Zweig, who wrote that Brazil was the land of the future? This is where we find out why his prophecy keeps failing. This is where Brazil's trap becomes truly inescapable. March 2014. Operation Lava Jato begins. What started as a routine money laundering investigation at a car wash in Brasilia uncovered a systematic kickback scheme. 13 construction companies had formed a cartel to rig bids and extract kickbacks of 1 to 5% on every contract. The money flowed upward to Petrobras executives who facilitated deals, to political parties that controlled appointments, to individual politicians who protected the system. The names read like a who's who of Brazilian power. Lula da Silva, imprisoned April 2018, conviction annulled March 2021. Dilma Rousseff, impeached August 2016. Marcelo Odebrecht, CEO of Brazil's largest construction company, 19-year sentence. Sergio Cabral, Rio governor, 300-plus years in accumulated sentences. The investigation delivered 361 first-instance convictions and recovered approximately 25 billion reais in fines and restitution. But the damage multiplied exponentially. Petrobras lost $250 billion in market capitalization and cut capital expenditure by 37%. The construction sector contracted by 30%. Researchers at FGV estimated the scandal reduced national GDP by about 3.5% each year between 2014 and 2017. That's $10 to $20 billion per year. Lost investments, 172.2 billion reais, about $34 billion. Lost jobs, 4.4 million. Do the math. The investigation was supposed to clean up Brazil. Instead, GDP contracted 3.8% in 2015 and 3.3% in 2016, Brazil's worst recession in over a century. Now here's the twist. In June 2019, The Intercept published leaked messages showing that Judge Sergio Moro, who had convicted Lula and become a national anti-corruption hero, had coordinated strategy with prosecutors. He passed tips, suggested investigation sequences. The judge wasn't neutral. The hero was playing for one team. In March 2021, the Supreme Court took two critical actions. Justice Edson Fachin annulled Lula's convictions, ruling Moro lacked jurisdiction. The Curitiba court's mandate was Petrobras-related crimes, not Lula's specific charges. Then the court ruled 3-2 that Moro was biased. Justice Carmen Lucia reversed her earlier position. Moro later joined the government of Lula's rival, Bolsonaro, as justice minister. Today, he serves as a diminished senator. The largest anti-corruption investigation in the hemisphere ended with its most consequential conviction reversed and its lead prosecutor discredited. And Lula? He won the 2022 presidential election. Attorney General Augusto Aras, who was appointed by Bolsonaro, said Operation Lava Jato left a cursed legacy. The UN Human Rights Committee ruled in 2022 that the proceedings against Lula violated due process guarantees. The economic costs, 172.2 billion reais in lost investments, 4.4 million jobs, far exceeded the roughly 25 billion reais recovered. Beyond corruption lies a structural problem. Doing business in Brazil is economically irrational. Tax compliance time? Over 1,500 hours per year. That's 188 working days just doing paperwork. Compare that to 150 hours in OECD countries. Total tax rate? 64.7% of profits. Unresolved tax claims worth 75% of GDP. Businesses spend years in court. Infrastructure investment. Brazil needs 4.65% of GDP annually. Actual investment? Barely 2%. One-third of emerging market norms. Transport costs. 13% of GDP versus 8% globally. If you're thinking this is insane, how does anything function? That's exactly the right reaction. It is insane. And yet, somehow, Brazil keeps growing. That's part of what makes this story so maddening. Here's how one expert put it. Laws in Brazil are very poorly written, a dream for lawyers. The macroeconomic impact of the lack of clarity in laws is severe, but there are always those interested in the lack of clarity. Here's the definition. Countries that grow rapidly from low income but stall before reaching high income. Of 101 middle-income countries in 1960, only 13 reached high-income status by 2008. 13 out of 101. Brazil's trap mechanism is straightforward. 1. Can't compete with low-wage countries like China and Vietnam on manufacturing. 2. Can't compete with advanced economies like Germany and Japan on innovation. 3. Stuck exporting raw commodities with volatile prices. The education deficit cascades through the economy. Brazil's 2022 PISA scores show students performing 93 points below the OECD average in mathematics, 379 versus 472. That's roughly equivalent to 4 years of schooling behind developed nations. Only 27% of Brazilian students achieved minimum proficiency in math, versus 69% across the OECD. Total factor productivity actually declined 2.2% annually from 2012 to 2019. Not stagnant, regressing. Manufacturing labor productivity was 54% higher than the economy-wide average in 1995. By 2023, it had fallen to 7% below average. Remember the Korea comparison from the beginning? Here's the payoff. In 1980, Brazil's GDP exceeded Korea's. Both faced a choice. Korea chose investment-led development, infrastructure and education in the 1970s, foreign technology into domestic firms in the 1980s, innovation leadership from the 1990s to present. Today, Korea spends 4+% of GDP on R&D. Brazil never progressed beyond factor accumulation. Korea's per capita income, $33,000. Brazil's, still roughly $11,000, same as 1980. So what happens when all these traps spring at once? The economics of Amazon deforestation reveal a profound market failure. Cattle ranching drives 80% of forest clearance, yet returns are marginal, roughly $75 per hectare annually. The real profit comes from land speculation. Deforested plots command prices around $2,000 per hectare, enabling owners to secure loans and flip properties. This logic has destroyed over 490,000 square kilometers since 1988, an area larger than California, releasing 4.1 gigatons of greenhouse gases from forest fires in 2023 alone. But here's the thing. The standing forest offers dramatically higher value if carbon markets mature. At $20 per ton of CO2, forest restoration becomes more profitable than cattle, potentially capturing 16 gigatons of CO2 over 30 years and generating $320 billion in revenue. European carbon markets already trade above $90 per ton. Under Lula, Brazil has slashed deforestation rates. Amazon deforestation fell to 5,796 square kilometers in the 2024 to 2025 period. That's an 11% decline from the previous year and a 50% cumulative reduction since 2022, when deforestation peaked. Third lowest rate since records began in 1988. 733.9 million tons of CO2 equivalent emissions avoided since 2022. Environment Minister Marina Silva, a former rubber tapper who learned to read at 16 and worked alongside assassinated activist Chico Mendes, has rebuilt enforcement. Yet threats persist. Congress overrode Lula's vetoes on an environmental licensing bill, potentially allowing retroactive legalization of illegally cleared land. And here's the ultimate contradiction. The EU-Mercosur trade agreement, finalized in December 2024, makes the Paris Agreement an essential element. Yet studies estimate it could accelerate forest clearance by 25% through increased beef exports, potentially clearing 700,000 additional hectares in the first year alone. GDP growth 2024, 3.42%. Sounds good, right? But debt to GDP heading to 84%. Inflation, 4.26% in December 2025, above target. Interest rates, 15%, among highest in the world. The paradox: strong growth funded by unsustainable debt. The harsh reality is this: Brazil isn't failing despite its resources, it's failing because of them. The commodity wealth created a currency too strong for manufacturing, a political system captured by agricultural interests, an economy dependent on China's appetite, and a society that never invested in education or innovation. Remember that fatal flaw in the real plan I mentioned earlier? Here it is. Anchoring the currency to fight inflation worked, but when commodities boomed, Brazil had no mechanism to prevent the currency from strengthening. No sovereign wealth fund, no capital controls that mattered, no industrial policy that could compete with free money from the ground. The very stability that saved Brazil from hyperinflation created the conditions that destroyed its industrial base. So is there any way out? So where does this leave you? Whether you're an investor, a policy wonk, or just someone who wants to understand where the world is heading, let's look at 3 scenarios for Brazil's future. Scenario 1. Gradual improvement. This is the base case, the most likely outcome. The VAT reform that passed in December 2023 gets implemented by 2033. Fiscal adjustment continues slowly, stabilizing debt around 85 to 90% of GDP. Growth averages 2 to 2.5% annually, better than recent decades, but insufficient to converge with rich countries. Brazil remains a middle-income country indefinitely, periodically boosted by commodity cycles. The real oscillates between 5 and 6.50. The Selic stays above 10%. Per capita income reaches maybe $12,000 to $15,000 by 2040. Not collapse, not breakthrough, just more of the same. And there are hopeful signs. The VAT reform is historic, replacing a Byzantine 5-tax system with a unified structure. Central bank independence survived the political transition. The new president, Gabriel Galipolo, Lula's own appointee, held rates at 15%. And the PIX instant payment system now handles 49% of electronic transactions. Brazil can innovate when it wants to. Scenario 2. Fiscal crisis and adjustment. Political resistance to spending cuts proves insurmountable. Debt to GDP approaches 100% by 2030. Then an external shock hits: Fed tightening, China slowdown, commodity crash, capital flight begins. The real collapses beyond 7 to the dollar. The central bank hikes above 20%. A crisis president implements emergency fiscal adjustment with significant social pain. The pattern repeats what happened in the 1990s and 2015 to 2016. Brazil has been here before. Scenario 3. Structural breakout. The optimistic case. Carbon markets mature, making Amazon preservation genuinely profitable. Chinese demand stabilizes at elevated levels. The VAT reform delivers productivity gains exceeding expectations. Infrastructure investment rises to 4% of GDP through new concession models. Education quality improves as demographic pressures ease. Brazil's fertility rate has already fallen to 1.6. The combination enables 4+% growth sustained. By 2040, per capita income approaches $20,000. Unlikely, but possible. Now here's something worth noting. Brazil has made significant poverty reduction progress. Extreme poverty fell from 9.3 million in 2023 to 7.4 million in 2024, the lowest rate ever recorded at 3.5% of the population, down dramatically from the 2021 peak of 18.9 million. But regional inequality persists. Northeast extreme poverty remains at 6.5% versus 1.5% in the South. If you hold emerging market funds, Brazil is likely 5 to 10% of your portfolio. Here's what to watch: Fed rate decisions, China PMI data, Amazon deforestation reports. These are your leading indicators. The Brazil trade is high risk, high reward, but the house usually wins. Stefan Zweig fled Nazi Europe to Brazil in 1940.